Hello everyone. In this video, we're going to be talking about the wheel strategy. I'm going to show you how to use the wheel strategy to develop passive monthly income using stock options. And if you're completely new to stock options, don't worry about it at all. This is a very beginner-friendly strategy here, so stick around. This is a really good one. And by the end of the video, you'll be able to identify stocks that are good for this strategy, and you'll also be able to start with your first wheel trade. Now, to get started here, you're going to need to have a trading account that is approved for options trading and specifically for trading cash secured puts and covered calls. Now, if you don't understand what cash secured puts are or covered calls are, we're going to be covering that later in the video, but it's important here to have a trading account that's approved for cash secured puts and covered calls. This is something that you can get through Robinhood or Webull, and I actually recommend both of those platforms here if you're just starting out because they do offer free options trading. So you're not paying for the transactions that you're making, you're not paying for any of the buying or selling of options here. So those are two good platforms to check out. I have a link in the description below that has a sign up for Robinhood or Webull. If you don't have an account there, you could sign up, deposit more than $100, and I think that you get one free stock with Robinhood or two free stocks with Webull. So after the video, make sure to get these accounts set up. So to get started, you're going to want to find a stock that you like and that you would like to own for a considerable period of time, a company that you really believe in. Next, you're also going to need to make sure that that company has options trading available. And I'll show you here on the screen how to identify, and this is in Robinhood, how to identify if there are options trades available. You can see that when you click on trade from the stock page, that it opens up a button that says trade options. If you see this button after you press trade, that means that there are options available for this stock. And next, you're going to want to make sure that this stock is also at a price where you can buy 100 shares of the stock. And that's important because at some point in the wheel strategy, you will be purchasing 100 shares of the stock. So if the price of the stock is $30, you want to make sure that you have $3,000 in your account in order to be able to buy that stock, 100 shares of it for $30 each, which would be $3,000. Now, once you have your stock picked out that fits all of the characteristics that we just talked about, you're going to want to sell a cash secured put. And let me explain what that means. For each contract of a put that you sell, you are selling someone the right, but not the obligation, to buy 100 shares of that stock at the agreed upon price, which is called the strike price, at any time before the contract expires. And when I say that we're selling this option, that means that we're taking in money up front in the first part of the trade. We are taking in a premium, which is the monthly income that we're talking about here. So when I sell a put in this strategy, there are two things that I want to consider. One is the expiration date of the contract, and two is the strike price of the contract. In terms of the expiration, I want to make the expiration date about 45 days from now. So I want to pick a contract that expires about 45 days from now. And in terms of the strike price, I want to pick a strike price that has about a 70 to 80% likelihood of expiring worthless. Okay, let's jump into an example here using MGM. Now we're looking at the contract that expires just under 45 days from today, September 18th. And here, circled on the screen, you can see the chance of profit. So that's a proxy for the likelihood of expiring worthless. And I'm going to sell one contract with a $20 strike price. And we're going to sell this put for $1.23 per contract, which results in a total credit of $123. If on September 18th, MGM closes above $20 per share, we keep the entire $123. If it closes below $20 per share on September 18th, we would then be buying 100 shares of MGM stock at $20 per share, regardless of where the actual price is. but there's about a 70% likelihood that the contract actually expires worthless. And when the contract expires worthless, we just do this again, and we do it again, and we collect more money for selling the put time after time after time. So it's great when it expires worthless, because then the next month comes around, we sell another put, we collect more money up front, and we wait to see if the option expires worthless again. So to be clear here, the option expires worthless when the stock price is above the strike price at the contract expiration date. And this is for this portion of the trade when we're in the selling put phase of the wheel strategy. And there is going to be a time when the stock price closes below the strike price at expiration of the contract. And that is completely fine. It is part of the strategy here. And when that happens, and it's going to happen, it's part of the strategy. When that happens, you're going to get 100 shares of the stock for each contract that you sold at the strike price. And now you'll have 100 shares of this stock, and then we move into the next phase of the strategy. And in this phase, you now have 100 shares of the stock, and you're going to be selling a covered call. You're going to be selling a call option. And previously we discussed selling a put option. Here with the call option, similarly, you are going to be collecting payment up front for selling that call option. And that's really important. That's part of the way that we're generating income. So we're generating income when we sell the put options and when we don't have any stock. And then when we have stock, we are selling call options to generate even more income. So there's this constant cycle of selling put options, getting the stock, selling call options, and then one of two things can happen. The first thing that could happen is that when the call option expires, the stock price is below your strike price. And when this happens, the call option expires worthless. We keep the premium that we collected up front, and we also keep the 100 shares of stock. And now immediately what we do is we sell another call option to collect another payment. And as long as the call options continue to expire worthless, we keep repeating this process until the price at expiration is above the strike price. Now, we still keep the premium that we collected when we sold the call option, but the 100 shares that we have, they're sold at the strike price. And then what happens is we move back to the first phase of the wheel strategy and start over by selling another put option and collect another payment. And that's it. That's the wheel strategy. It really is a great method to generate passive income. If you have any questions about the wheel strategy, drop a comment below. I read all of the comments and will be happy to respond to your questions here. And if you're going to use the wheel strategy, let me know in the comments. Let me know which stock you're using it for. I'm interested to see what everyone's thinking. All right, see you in the next video.